Stock buybacks, they suck. Or do they? Well, to answer that, we need to know what stock buybacks are, and before that, we need to explain what stocks/shares are. A stock or share represents a partial ownership of a business. For instance, if a business issues 10 shares, a shareholder owning one of these shares would own 10% of the business. The whole point of these shares is that they usually pay dividends, and sometimes allows the shareholder to have some influence in the running of the business. Stock buybacks or share repurchases refer to companies repurchasing their own stock from shareholders in an open market, which limits the supply of shares, boosting its value. For example, let's look at the same business with 10 shares owned by the shareholders, and each worth say $10, since the entire company is worth $100. The company decides to buy 5 of these stocks with $50 of cash, which cuts down the available company stocks to 5. Due to this, the company's worth of $100 is divided by the number of remaining stocks, which is 5, and this means the company's stock price has risen to $20. As you can see, stock buybacks increase the price of shares. Stock buybacks were illegal, or at least potentially faced civil and criminal penalties until 1982, when the SEC relaxed these rules. There were 1992 tax deductibility changes for corporate pay, which included a loophole for CEO performance pay via stock options. But why does any of this matter? Well, a rise in the value of shares benefit corporate executives by raising the stock-based compensation and can cash out their personal stock holdings. So this means there is a major incentive for executives to engage in stock buybacks, since a higher earnings per share means higher compensation for executives. But more importantly, usually when a share price of a company rises, it is usually based on something like more investment, better customer satisfaction, or higher market demand for the company's product or service, things that help the economy. But when looking at the phenomenon of stock buybacks increasing stock prices, there seems to be no clear reason for how it may benefit the overall economy. It has been pondered that buybacks just artificially increase share prices. And the real kicker in all of this is that buybacks supposedly lead to less resources for research and development, capital investments, new technologies, and new jobs. Remember our $100 company example. That company executive used $50 to buy back their shares, $50 that could have instead been used on investment and wages. Granted, $50 is pretty small, and a company worth $100 engaging in buybacks is pretty unrealistic, but this example is just for brevity. Let's instead look at buybacks from a more macro scale, by looking at a very controversial policy. Trump's Tax Cuts and Jobs Act of 2017 had brought the debate on stock buybacks into focus. Oh, you remember when he was president? Or that he still thinks he's president? Anyway, after these tax cuts passed, 57% of corporate tax savings went to stock buybacks, in contrast to 20% for job creation commitments, and 6% went to wage increases. Hence, major criticism was levied against the tax cuts on the basis of perceived inequality that favors buyback and disproportionately benefiting the rich. Buybacks seem to be the norm, as within 14 out of 18 industries, most companies spend over half of their profits on buybacks. Not to mention that 54% of corporate earnings was used to buy their own stock from 2003 to 2012 versus 5% of earnings back in the early 1980s. America also is the least regulated on stock buybacks of any country with a major stock exchange. As you can see, these factors have dramatically raised concerns that the large levels of stock buybacks is cutting down vital investment in companies, particularly in America, and this concern has spread to online political pundits like Sam Seder.
And I think that there's some evidence that this has led to a decrease in corporate investment, and thus to companies taking cash and just getting their shareholders richer instead of becoming more innovative or more efficient. And then, there's this issue that here companies have made this argument that they can't pay workers more, but they clearly can. And I do worry that even putting the worker issue aside, if we've seen this dramatic decline in corporate investment and we feel like productivity is low, what is that doing to corporate dynamism?
This all sounds interesting, but there is one argument within financial theory that disputes this claim. The theory states that when companies become older and have excess cash, they find that they have much fewer opportunities for investment because they have already made all possible investment opportunities. Shareholders invest in companies to get the best return possible, but if these large, older companies have a lack of investment opportunities, then they will spend their excess cash on bad investments, which gives a lower return or even no return. This is quite a waste when shareholders could instead use their cash on more profitable investments instead. This is where buybacks come in. When companies engage in buybacks, they return cash to shareholders who can then use their money on newer, smaller companies who are more innovative, will give the shareholders a better return and are less wasteful. Proponents of this theory will further argue that the price will only increase if investors see the buyback as value enhancing. They may elaborate that if there is a lack of profitable investment opportunities but the company spends money on investment anyway, then they are not making effective use of their capital, which means their share prices fall. This reinforces the idea that companies are justified in redistributing excess cash flows to shareholders. After all, it is logical to assume that there's idle cash in the system or slack that prevents efficient investments. However, critics of this theory point out that the size of shareholder payouts is significantly higher than new net stock issuances, which is minus $580 billion, meaning that funds are being pulled out of the stock market rather than being recirculated. And since 2000, when stock buybacks had been rising significantly, business dynamism and entrepreneurship have declined, with the entry of new firms falling. So when taking into account these two factors, it appears that we can assume not much from the cash flows from stock buybacks is actually transferred and invested into new companies. My audience is more mixed in this assumption, but over half still think buybacks are used for detrimental purposes of just executives purely increasing earnings per share. If you want to participate in my channel polls, you can head to my community tab as well as subscribe to check out more of my content related to stock buybacks and other economic topics. Anyway, so what percent of stock buybacks is reinvested in new companies? 10%? 20%? 30%? 40%? 50%? It definitely cannot be more than that, considering the data we just saw, right? Well, type in what you think the answer is in the live chat or in the comments first. Okay, have you typed it in yet? Great. When looking at the data, it turns out that 96% of stock buybacks are reinvested in the market, where they are presumably reinvested in other stocks. You heard that right, 96%. That's a big surprise there. Looks like 1% in my community poll got it right. But why is this contradictory to the data I mentioned before? Well, it isn't necessarily, since causation is not correlation. And it can be both true that the investment environment in America can be really bad, while at the same time most of the proceeds of stock buybacks is transferred to new companies. In fact, a bad investment environment since the 2000s can encourage companies to redistribute via stock buybacks to avoid a lower share price and for shareholders to spend on better investments. So pretty much distributions to shareholders fuel growth, because they fund new entries into the public market, so are crucial for entrepreneurs and investors to repeat their investment patterns into new small businesses who can generate vital new jobs. But what is interesting is that it can be argued that the concept of companies, at least older ones, to retain and reinvest excess cash in R&D or higher wages is a throwback to stagflation, because as you may remember earlier, older companies with excess cash flows but a lack of investment opportunities may mess up their investments and lower the share price, hurting the return for investors. Ineffective or wasteful investments may raise costs but lower or stall supply, leading to the stagflation phenomenon of high rising prices and low productivity.
There's a lot of arguments that a better way to return money to shareholders, which is something that companies absolutely do, is through dividends, which is basically where you just kind of issue cash back to the people who own the shares instead of buying the shares.
It's interesting you say that, because dividends have a reinvestment rate of 92% compared to stock buybacks 96% as mentioned before, so buybacks are better at redistributing to new startups. This is probably because investors see dividends as a better source of income than buybacks, though the reinvestment rate difference is small. You also can't control for dilution of the share price with dividends, so the market can unjustly hurt the company when they issue new shares. And dividends cause unnecessary volatility, possibly causing the share price to be worth less. Both stock buybacks and dividends are great at distributing value to shareholders, but both have different uses and can't adequately replace the other. Still, There is a lot of nuance to the stock buyback debate, especially relating to investment, and I'm not done with this yet. I plan on releasing either a part 2 and part 3, or maybe just a part 2 which talks about the correlation between investment and buybacks outside of reinvesting in new companies, as well as a follow-up to this part 1. And all of this is part of a series relating to stock buybacks and investigating whether it should be banned, with my first entry being an analysis of Biden's stock buyback tax from a few months ago. I will also look at the significant oil stock buybacks, and I even plan on revisiting Sam Seder's video sometime in the future for a more detailed analysis. If you're interested in that type of stuff, please feel free to subscribe as well as give a like and comment, as it really helps my video in the YouTube algorithm. I also got a new mic and was wondering how you guys liked my sound quality. Regardless, thanks for watching, follow me on Twitter, as well as check out my content on Rumble, and see you later.